In this video segment, I'm really going to explore the mechanics of monetary policy, and there are two parts to this. The first mechanical part is just understanding the money multiplier, and then the second one is really exploring how open market operations affect interest rates, and that is very easy to tie into how that heats up or cools the economy. So let me start with the explanation of the money multiplier. Now, the money multiplier, the purpose of that is for us to be able to see how it is that when there is new money brought out of the Federal Reserve's vault, metaphorical vault, and put on a bond trading desk, how that spreads through the economy, or through the banking system more specifically, and really expands the money supply many more times than it is. And the reason that happens is because when they lay that money down, the bank is required to keep generally 10% of it, but lends out 90% of it. And then other banks, when that 90%, that money is deposited there, they lend that out, and so forth and so on, as we described before. So what we want to know is how much total impact does an initial increase in the money supply have on the overall money supply, and the money multiplier gives us that difference. And there's an easy way to calculate the sum of all those ripples as it moves through the banking system. And so the money multiplier is equal to 1 over R, where R is the reserve requirement of the Federal Reserve. So most of the time, that is, just as a rule of thumb, is 10%. Now, it is a tool of the Fed. They could change it. But that is usually equal to 1 over 0.10, representing 10%. So that would mean that the money multiplier is 10. And so the application of that is for every, let's say, $10 million that the Federal Reserve might lay on a bond trading desk of new money, well, that's the initial amount times the money multiplier is equal to the total change in the money supply. So if they lay 10 million down, then that's 10 million. And if our money multiplier is 10, because the reserve requirement is 10%, then it's 10 times 10. And the total change in the money supply will be 100 million. What if they want to cool off the economy? Well, if they want to cool off the economy, they go over to the bond side of their vault, metaphorically. They take out the bonds, they lay those on the bond trading desk, they say, give me the money, and they take the money out of the system. What will be the impact of that? They're taking it away. So it works the other way too. That's the role of the money multiplier. It's not very complicated. I think sometimes it's an exercise, more of a way to test Econ 101, 102 students than it is to enhance understanding, because you don't actually have to do much calculation of this ever in your life. But what is important to know is why this change in the money supply has an impact on the economy, or how it has an impact on the economy. So that having been explained once, I'm going to move on from as quickly as I can. I just don't think it's necessary in your lives. It's, as I said, I think it's an exercise as a rite of passage in these courses more than anything. So how does doing that affect the economy? Well, this also gives us a chance to review supply and demand, because we're going to apply it to a different good than we have before. The good that we're going to apply supply and demand to is money. What? Money is a good? No, money is what you pay for goods. That's true. But we can treat it like a good itself, holding all else constant. Is there a price you pay to get money? Or is there a price you pay if you can get if you want to sell money? There sure is. It's called the interest rate. So it works like this. Here's money, the supply, the total money being transacted in the market. This is for money. Here's interest rates, and it depends on, there are various kinds of interest rates, there are different terms, but for now let's just use R to represent interest rates just to bring home how this works. And there's money demand. And the reason that demand is downward sloping for money is because at high interest rates, I and you and most people would like to have less liquid money because we'd like to have that put away in something that bears interest. So the demand for money is lower at higher interest rates. But when interest rates are very low, well, I might as well have more cash on hand. Now, this is a little different than we've seen before. The supply of money is vertical. And the reason that that is vertical, or we could say perfectly inelastic, but nobody does that. The reason it's vertical is because it's determined by the Federal Reserve. They can decide how much money to supply the banking system because they have it locked away in a vault. And if that doesn't work, they can just create new money electronically now with quantitative easing. So we are not too concerned with money, the equilibrium quantity of money down here in the market for money. What we are interested in is right here in what it does to interest rates. This is just another way to, well, maybe to add a step to what I said with the bonds. So let me start with the bonds at trading, okay? Let's suppose the Fed wants to heat up the economy. What do? Do they buy or sell bonds? I like to think this through with the volts every time to check myself. If they want to heat up the economy, then what they do is they buy bonds. So they take cash out and they lay that on the bond trading desk and they take bonds and they lock them in the vault over there. And by doing that, that money goes through the banking system by a factor generally of 10, the money multiplier. That increases the money supply. And what does that do? Pushes down on interest rates. The rate that they happen to focus and target on is called the Fed funds rate. That's the overnight borrowing rate from one bank to another. It's different from the discount rate, which is the tool the Fed can change directly. This they change indirectly, the Fed funds rate, through changes in the money supply through open market operations. The point is they've lowered the price of short-term borrowing. Well, if interest rates are down, how does that make you feel about maybe buying cars, you being consumers? Buying a car, a big part of buying a car for most people is the price of the car alone, right? Well, if interest rates are lower, that makes buying cars more tempting. How about buying things on credit cards if interest rates are lower? That's more tempting. Financing things that you can buy that the seller has an arrangement with some kind of a bank where they'll finance it. You know, buy now, no payments for a year, and you can finance it for 5 years, like a hot tub. Things like that. They sell those things with a finance plan as well. When interest rates are down, all those things become more tempting to people. Also, here's a dual side to this. It's kind of a downer, but neat to think about at the same time. If interest rates are down, how desirable is it for you to keep money in the bank? It's not as desirable because it doesn't pay as well. You see, interest rates represent the opportunity cost of consumption. The higher they are, the less desirable it is to consume stuff because you could get more by saving. But when they're low, I mean, consuming stuff is pretty fun anyway. But if it doesn't pay to save, why not go buy more stuff? And why do I keep talking about buying cars or hot tubs and finance things you can finance? Because, or would buy even if you weren't financing them, because keeping money in the bank doesn't pay as well. Why am I talking about consumption? Because when we buy stuff, people have to sell us that stuff. They have to make that stuff. They have to install that stuff. I just named 3 jobs in general about stuff. It enhances employment when we buy stuff. It increases employment. So what's the stages here? If the economy is down, the Fed increases the money supply. When they increase the money supply, that decreases interest rates. When that decreases interest rates, that increases consumption and investment because firms can borrow. and that pushes up on output. So that's how the Federal Reserve, through the money supply and open market operations, can heat up the economy. In our aggregate supply and aggregate demand framework, these were the determinants of aggregate demand, if you remember. Should have drawn this last. I want this to be like here. Here we were at a recessionary gap below our long-run potential when things, as I said, weren't good. There's downward pressure on prices anyway. Now, if the Fed does this increase in C and increase in I, determinants of aggregate demand, are these things that are the components of the national income identity. The idea is to raise aggregate demand back to here. So that is the Federal Reserve with an expansionary monetary policy, increasing the money supply through the interest rates should increase aggregate demand to close a recessionary gap. Now, I said the Fed, they're also called the party poopers, or they pull away the punch bowl. Well, if aggregate demand had been out here instead, a very hot economy, hence the red, well, now we have a risk of inflation. We have upward pressure on the price level. And when people are working overtime and they have a lot of money in their pockets, and that can lead to them spending more. So what does the Fed do? Now they go to the bond trading desks instead of with money, with bonds. They lay the bonds down, they take away money. When they take away money, they decrease the money supply. And what does that do? Pushes up on interest rates. Higher interest rates, no. Time to cool off the economy. Let's get it back down. That is the mechanics of the Federal Reserve and what they do for us fairly regularly since the 1950s with open market operations.